Episode: renting versus buying a home in Kenya. So, most Kenyans, this is an ever ongoing discussion, and most Kenyans are always uh, arguing about renting versus buying as if one option is always right and the other one is always wrong. To some people, renting is throwing away money, and others say that buying a house, especially on mortgage, is financial slavery. And because everyone around you has got an opinion, your parents have an opinion, your friends have an opinion, your agents have an opinion, even social media is flooded with opinions, the decision starts to feel more of an emotional, a stressful, and a confusing decision to make. So, in this video, I'm not here going to tell you what to choose. By the end of this video, you will not be convinced to buy or not to buy, but instead, you will have a deeper understanding on what each option actually demands from you, both financially, mentally, and lifestyle wise, so that you can make a an informed decision that doesn't fit the people around you but fits your life. Because the truth is that this debate is not such a simple debate as people make it sound to be. To make this practical, let's use a very normal Kenyan example. I'm going to choose a house, not a luxury house, not a village house, not a gated house in premium estate. Let's talk about a standard two-bedroom house, a standard two-bedroom house in a medium location. In many places in Kenya, such a house might rent for 15,000 to 25,000 shillings per month. So you're talking about rent to be between 15K to around 25K. And you might be in places where a two-bedroom house is expensive than that or is less than that. I'm talking about average. So don't come blazing guns. If you are to buy a similar house in a comparable area, it might be around 7 million Kenyan shillings. And similarly, that is a rough estimate. It's an average amount. Because there are such like houses that will cost 20 million and others will cost 30, others will cost maybe 2 million. So now these are not exact figures. These are reasonable averages so that we can think clearly and work around a particular figure. Now, with that picture in mind, a two-bedroom house, 15 to 25K in rent and 7 million to buy. Let's walk through options. Option 1, renting a home. Renting a home. So, renting, we are starting with renting because renting is often treated like failure, when in reality, it's a strategy. What does renting give you? When you rent, the biggest thing that you are paying for is flexibility. You can move in cities if your job changes. You can relocate if your income changes. And you can either upgrade or downgrade, upsize or downsize as your life changes accordingly. And for many Kenyans, especially young professionals and entrepreneurs, the tech bros and whichever, income is not perfectly predictable every month. Why? Because we have got variations. Sometimes income will come, sometimes income won't come, especially for those people who are entrepreneurs, people who work online and freelancers. And it's important for you to know that this matters more than we can admit. So renting gives you flexibility. Renting also keeps your cash liquid. Your money lump sum is not locked in a house somewhere. It's available for emergencies, for investments, and for business opportunities, even relocation when need be. So renting is not wasted money. Rent is payment for flexibility and optionality. So anytime we talk about renting, remember these two words, flexibility and optionality. But what are the cons, downsides of renting? Rent sometimes usually increases with time. Your landlord will decide that we are no longer paying 20,000, we are paying 22,000 or 24,000. So rent can increase with time. You don't, number two, disadvantage, you don't build ownership because you are renting, you are not owning the house. And then number three, you don't have full control over the space that you have. And let's be honest that in Kenya today, renting also comes with social pressure. And there's a psychological weight to the word that, are you still renting when it comes to a certain age? So renting buys flexibility, but it costs you long-term security and control over space. Option two, option two, buying a home. And under buying a home, we have got two options, two paths. Buying with cash and buying through a mortgage. These two are very different experiences, and let's have a look at them. Benefits of buying with cash. When you buy a house with cash, there is no bank involved. So this means that there's no interest. Number two, no monthly pressure. And number three, no risk of defaulting the house. The moment you buy the house, the moment you pay the money, either upfront or installment, you own the house outright. The house becomes yours from the word go, and that gives you a peace of mind. Your housing costs becomes predictable because you know the amount that you paid upfront or the amount that you'll be paying depending with the month that you are given, the repayment plan. And so the rent increase no longer affects you. You own the house outright. And for many people, this sense of stability feels like freedom. Let's look at the opportunity cost of buying with cash. And we've explained this term. Opportunity cost simply means, what else could this money have done if it's not tied up in the house? We talked about 7 million. So if this 7 million is not in a house, what else, where else could this money be? And if you put 7 million shillings in a house, that money is no longer liquid. You can't easily access that money, and you can't quickly redirect that money into a business, an investment, or an emergency fund. So you forego those other things to put this money into the house. So the real question becomes, is owning the house worth giving up that flexibility? So buying with cash gives you certainty, but it can limit your options because you don't have the flexibility that you would have had when you had that money. Now, there's something known as rent and invest difference, and you'll hear this on platforms and people talking about this. So, and people will always tell you, instead of tying up all your money in a house, do this, rent and invest the rest. And so I just want us to talk about it. So it's a thinking, a framework that I want us to apply. So let's say that instead of paying outright 7 million, you decide to rent, and the rent is maybe 20,000. You decide to rent a similar two-bedroom house for about 20,000 per month. So even if you pay for the whole year or for 6 months, you still have around 6 million that you can invest. So that, sorry, instead of putting 7 million in a house and losing the flexibility, you put maybe 200,000 as rent and you invest the rest. So imagine that you take 6 million and put into a business that can give you 40% interest, or put in a high yield investment or a money market fund, or even in a diversified investment portfolio. I'm not promising returns. I'm just here to think differently. If that money earns interest over time, then money starts working for you while you rent. So that the 7 million that you would have paid straight as rent, some of it is working for you and it's no longer fixed in a house. So that you are not just renting at that particular time, you are renting and also building wealth somewhere else. This is the logic behind rent and invest the rest. Of course, this will only work if you are disciplined and will get to invest the money. If the money sits idle or gets slowly spent somewhere else, this strategy completely fails and doesn't serve its purpose. So this is not just a financial strategy, but it's also a behavioral strategy. Now, we've looked at buying with cash. Let's look at buying with a mortgage. And we will do some math here. So I'm getting my paper ready. Buying with a mortgage. Now, why do people choose mortgages? A mortgage, number one, allows you to access a home earlier than you could have with cash, or if you don't have the whole amount at first. Number two, mortgages will also create a forced discipline. By that we mean at the end of the month you have to be paying that 50,000. You are compelled to make regular payments over time so that you build your ownership. For people with stable and predictable income, this can work. Now, let's look at the hidden reality of mortgages. However, mortgages come with the realities that are often overlooked, that are often glossed over. Just people don't look at those realities. In early years of mortgage, most of your payment is not building ownership, it's servicing the interest. Let me explain. If you take, and I have an example. Suppose you take a 30-year mortgage, and we shall be doing the math. Suppose you take a 30 years mortgage, we have here our 30 years, with a monthly repayment of 50K per month. You're paying 50K per month, and it's a 30 years mortgage. After 15 years, you would have paid 50 times 12 times 15, and that is 9 million Kenyan shillings. So after 15 years, you are paid 9 million shillings. And so in your mind, you would expect to own maybe a half of the house. But that is not how it works. The math of compound interest is different. So we shall have a rough interest that in Kenya may be 12, 13, 14%. So if we take 13.5%, after those 15 years, nearly 85% of the 9 million, 85% of this 9 million will not have gone towards paying the house. This money would have gone towards paying your interest alone, because there's what we call, there's a term I'm looking for. Is it either interest forward or forward interest, where the banks will always collect the interest first. So after 15 years, the 9 million that you will have paid, 85% of it will have gone to pay interest. And this translates to something like around 7,650,000. So after 15 years, you've paid 9 million, but out of the 9 million, 7,650,000 would have gone to pay the interest. This means that you still owe the bank around 80% of the original loan amount. So you've spent 15 years paying, and you only truly own about a fifth of your home. Now, why does this matter? This conversation. This matters because your income must remain stable for decades. Your job, your health, and your circumstances around you must cooperate perfectly so that the 50,000 is always going to pay the mortgage. And for many Kenyans whose income may fluctuate, this creates immense long-term psychological pressure. So, what am I saying? That a mortgage does not just affect your finances, it affects how you freely make your life decisions. When you owe the bank 80% of a house after 15 years of work, you are less likely to take risks, either when you're doing business, when it comes to travel, when it comes to changing careers. So you aren't just buying a home, you are trading your mobility or debt that clears at a very slow pace, at a snail's pace. So, the hidden cost of buying. So, we've talked about buying under cash and under mortgage. So, what is the hidden cost of buying? When people compare rent to buying, they usually compare rent and mortgage payments only, and they overlook some other things. That comparison is incomplete. When you own a home, you deal with other things that are normally not mentioned: repairs and maintenance. Talking about insurance, we are talking about service charges or estate fees. We are talking about property rates. We are talking about unexpected costs when things break apart. These costs do not appear on day one. They slowly show up, they quietly show up over a long period of time. And when you eventually sell the house, there are costs such as agent commissions or fees, legal fees, and repairs to make the house look marketable and presentable. Therefore, buying is not just the price of the house. It's a long chain of ongoing obligations that are normally not clear upfront. Now, what is the big realization? Once you account for rent, purchase price, interest rates, hidden costs, opportunity costs, flexibility, and liquidity, something important becomes clear: that for many people, the financial difference between renting a home or buying a home is smaller than they expect. And it's not zero, but smaller than the emotional weight attached to it, which leads to a powerful realization that this is not purely a money decision, it's a life decision that you have to bear with. So, I have a decision framework that will help you make a decision, so that instead of asking which one is better, ask yourself these three questions. Number one, do I want stability or flexibility? If you want, do you want roots? Do you want somewhere that you will live forever? Or do you want options? Question number two, is it a matter of cash flow, or capital? Can your income comfortably support long-term commitments? Question number three, life direction. Are you settled, or are you still exploring? Of course, if you are settled, get a house, buy. If you are still exploring, then you need flexibility that comes with renting. When the numbers are close, the questions decide everything. So, to conclude this discussion, there is no a universally smart option for everyone. Renting is not failure, and buying is not success. Similarly, the mistake is not renting, the mistake is buying too early. And The mistake is not buying, but the mistake is buying blindly without weighing all the costs, the opportunity costs, and all factors that you have discussed. So choose the option that fits the life that you are building right now, and not the life that the society expects you to live or expects you to have. I'm curious, what matters more to you right now? Is it stability or flexibility, and why? Let me know in the comments. And if this video helped you to think differently, clearly when it comes to renting or buying, then it served its purpose. And let let me know how it made you think. And of course, subscribe if you haven't, and let this discussion reach out to people who are considering between renting and buying. Until next time, thank you for watching, and bye bye for now.